Welcome to today's session, guys. Today we will be looking at a very important topic from your ACCA FR exam point of view, that is goodwill. You should expect a goodwill calculation as a part of every ACCA FR exam. In that, you will be expected to calculate goodwill figure as a part of consolidation or group accounts question. We will learn how to calculate the goodwill and the working which we are supposed to show as a part of our exam. But before looking at the calculation part, let us look at the definition of goodwill. So, goodwill is an intangible asset which reflects an entity's value over and above its recorded value in the financial statement. It is often referred to as representing the reputation of the business. So, when you are talking about goodwill, it is an intangible asset without any physical substance, which reflects the entity value over and above its recorded value in the financial statement. So, when you are talking about goodwill, it is created by reputation of a business. So, when you have business, you will basically have good relationship with the customers. So this good relationship creates reputation by, let us say, for example, you are providing good quality product or rendering good services, you are providing after sales, or you are delivering products on time. So that will create a reputation from the business point of view. This reputation which is created will add value to the business over and above the value which is recorded in the financial statement. So the extra value which is created by your relationship or reputation with the customer is basically what goodwill is. So when you are talking about goodwill, there are two types of goodwill. One is internally generated, the other is goodwill arising as a result of business combination. So let us look at what internally generated goodwill is and why it is not recognized as an intangible asset in the statement of financial position. So when you are talking about internally generated goodwill, you are not supposed to capitalize it and recognize it in your statement of financial position, in your standalone individual statement of financial position. So let us look at what internally generated goodwill is. So I'll give you an example. So suppose you are running a restaurant from, let us say, last 5 to 10 years, and let us say you have obtained good ratings on, let us say, Zomato or Google reviews. So this is basically done by, basically, could be because of you providing a tasty food or giving a quick serving, or you have variety of dishes which is not available in other restaurant. So here you are basically getting good reviews, ratings, by basically making a good relationship with your customers and creating value. So when you are valuing your business, it's not just the asset which your restaurant has, right? There is something beyond that. So you are actually providing good quality services, product, and other thing, right? So you have created value here. So this value which you have created over and above your value of the asset is basically goodwill here. So as you have created the goodwill and it is internally generated rather than you purchasing another entity and obtaining a value, so here you yourself is generating the value, right? So you cannot recognize it. The reason is, here you cannot measure the value of the reputation which you have created, right? So you cannot capitalize it as a part of financial statement. On the other hand, you have another type of goodwill which is arising as a result of business combination. So what is business combination? So let us take an example. You are a business. Let us say your business is company A, and you want to expand your business. So what you did is basically you acquired another company. Okay, so when you acquire another company and you obtain control in that company, you are supposed to combine the business accounts and prepare a consolidated financial statement. So when you acquire another entity, you pay more than what you get, right? So you will get asset and you will pay more than what you have acquired, right? So here goodwill again arises as you're paying more than what you have acquired, and here you can measure the amount as well, right? Because you're paying certain amount, that's the consideration which you're paying, and the net asset which you are acquiring. The difference between these two are basically called again goodwill. Okay, so if you look at here further, so goodwill arises when the value of a business as a whole, that is your cost of investment. So when you acquire another company, you invest certain amount plus any non-controlling interest. We will look at non-controlling interest later. That is the share which you have not purchased. Exceed net assets acquired. So whatever you have acquired and the amount which you have paid to acquire those shares is exceeding, in that case, goodwill will arise. So if you look at here, so when you look at the pro forma for calculation of consolidated goodwill, you have to take consideration. So consideration is the amount which you have paid to acquire the investment. That is your cost of investment. Okay, and you have to add non-controlling interest. So what is non-controlling interest? So when you acquire another entity, it is not necessary to basically acquire 100% to in order to gain control in that entity, right? So you may have, let us say, 60% shares in another company and still basically have control over that entity. The 40% shares which you have not purchased, so that is basically a non-controlling interest. The value of those 40% shares, if you go and buy those 40% shares which you haven't acquired, how much will you pay? That is your non-controlling interest. Again, there are different valuation which you may be asked to use for non-controlling interest. So you have non-controlling interest as a proportionate share of the net assets, or you may be asked to calculate non-controlling interest based on its fair value. Again, that will be given in the question. So you will take the consideration transferred, that is the amount which you have paid to acquire that control in that entity which you have acquired, or the investment which you have made in another entity, the amount which you paid to basically uh, acquire the control, that will be called consideration transferred. Again, consideration could be in different form. You may pay cash to acquire shares in another company, so that is basically called cash consideration. You may have a share exchange. You are not actually paying cash, but you are exchanging your own company's share to acquire another company's shares. So here your consideration will be in the form of shares. So you have to value those shares and take into your consideration transfer. Okay, so you have other type of consideration: contingent consideration, deferred consideration, which again we will look at later in the next session. Okay, so consideration transferred, you have to take again, that will be given in the question. Suppose you have acquired 60% shares in X company for, let us say, 100,000. So consideration transferred will be 100,000, the amount which you have paid to acquire the 60% share in the company. Okay, next, you have to take the non-controlling interest. As I told you earlier, the amount of shares which you have not purchased, so that is basically your non-controlling interest. So in our example, as we have acquired 60% of the shares of another company, so 40% shares will be your non-controlling interest. As I told earlier, non-controlling interest can be valued as a proportion of a net asset acquired, okay, or you may use the fair value, okay. So depending on the question we have to calculate, we will look at the different calculation of NCI later, okay. Less fair value of net asset acquired. So when you are buying another company, you will be buying the asset of the company, you'll assume the liability of the company, correct. So the company which you have acquired, so we need to find the fair value of those assets and liability. So basically, we have to value the net asset at the date of acquisition, and we have to deduct the fair value of net asset acquired. Again, we have to use fair value here. Fair value, again, it's not necessary that when you acquire another entity, they will be preparing their financial statement and having fair value uh, of the, let us say, asset. So say for example, if you look at property, plant and equipment, so IAS 16 allows you to account property, plant, and equipment uh, on cost basis or revaluation basis. So when you are using revaluation basis, generally assets will be recognized at fair value. But when you are talking at about cost model, so it will be accounted at cost less accumulated depreciation. So we need to find the fair value again. When you are talking about your exam point of view, you will be given a fair value of the net asset acquired. So you have to take basically the acquired companies equity, so retain earnings, share capital, and pre-acquisition reserves, and any share premium or any other reserves, okay. So that is your fair value of net asset acquired. When you deduct that, you will get goodwill. So if you again look at the definition here, or how to calculate the goodwill, so here they have told you value of the business whole. So this is basically consideration plus any non-controlling interest, okay, exceed net asset acquired. So this is what we are deducting here in order to arrive at goodwill. So let us quickly look at the do an activity on goodwill, on how to calculate. We will do the working here. So here you have the question. So Sing company gain control. So let us look at the requirement first. So you have a question until here. So calculate goodwill at the date of acquisition. So that is the requirement. So let us read the question. Sing Company gained control of Wing Company on 31st March 20x5 when it acquired 80% of its ordinary shares. So if you look at the question here, so Sing Company has gained control over another entity, right? That is Wing Company. So when you obtain control, so there is a business combination here. And whenever there is a business combination, goodwill will arise. So what we are supposed to do is we need to do this type of working in order to find goodwill. Okay. The draft statement of financial position of each company were as follows. So you have been given the draft financial statement of the two companies, that is the parent, the one who has acquired the subsidiary. So Sing company is parent here, okay, and the company in which they have obtained the control is basically called a subsidiary. So Singh Company statement of financial position as at 31st March 20x5 is given. So you have the asset. So you have a non-current asset. So you have investment in 40,000 shares of Wing Company at a cost. So this is the consideration which you have paid. So you have paid the 80,000 in order to acquire 40,000. So 40,000 is basically 80% shares which you have acquired in that company. You have the current asset, you have the total asset, then you have equity and liability. So this is of the parent. So you have again been given a wing company, the company in which you have invested. You have the statement of financial position as at 31st March 20x5. So you have the current asset of 60,000, you have the equity, that is 50,000 ordinary shares of $1 each, and you have the retained earnings of 10,000. So again, we need to know the uh, non-controlling interest, as I told, we can take as a proportionate of of again fair value of the net asset acquired, or we will be given basically the fair value of the non-controlling interest. So in this case they have given the fair value, so we have to use this fair value in our calculation to find out the goodwill. Okay, so let us quickly start the solution. So I'll open a page here. So first thing, what we are supposed to do is, I'm writing here the title. Let me choose this. Okay, so you have goodwill working. So first thing here we have to take is the consideration transferred, the amount of investment which you have done in the subsidiary. So here the consideration or the amount which you invested in the company to acquire basically the share is 80,000 which you have here. So this is the consideration which you have paid in order to acquire the shares. So I am writing here 80,000. So I'll write dollar here. Okay. So next, which the next thing which you have to take as per the format is the non-controlling interest. So again, we have been given the value of the non-controlling interest here. So they have given the fair value of the non-controlling interest here. So I'll be taking the fair value of the non-controlling interest. So I'll just write here fair value of non-controlling interest. So what was the amount? It was 12,500. Then we need to deduct fair value of we need to deduct fair value of the net asset at the date of acquisition. So we have to look into the subsidiaries financial statements and take the net assets. So again, net assets we have been given. So basically, you have two net asset here. Okay. So one is your ordinary share, that is 50,000, and your retained earnings. Okay. So 50 and 10. So fair value of net asset acquired. So I'll write here ordinary share, and that is 50,000, and your retained earnings, that is 10,000. So I'll write here retained earnings 10,000. So total net asset which you have acquired is 60,000. So I will deduct that from the total of consideration and fair value. So you have 92,500 minus 60,000. So 32,500 is your goodwill at the date of acquisition. So you are paying 80,000, plus you haven't acquired shares worth of 12,500. So total, basically, if you want to buy 100% of the company, so you need to basically pay 92,500, but you are getting only a net asset worth of 60. So you are paying more than what you have acquired. So that is what is your goodwill. So here you have 32,500 as your goodwill figure. So this goodwill will be shown at the date of acquisition. You will show this goodwill in the consolidated statement of financial position. So I've written here COSP, CSOP. I'm supposed to write consolidated statement of financial position, CSOF. Okay, so this is what we are supposed to do. So under non-current asset, we will show goodwill as 32,500 in Singh's companies or Singh Group's consolidated statement of financial position. Okay, so when you are talking about goodwill subsequent measurement, you you need to basically review or test the goodwill for impairment each year. Again, we will be looking at impairment in the next session. So we have another question uh, regarding the goodwill calculation. So you have activity number 2. We will do this. Okay. So this is a small activity. So here you have again asked to calculate the value of goodwill at the date of acquisition, but there are certain assumptions which we are supposed to make. So required calculate the value of the goodwill at the date of acquisition, assuming NCI is valued at fair value of 1 million. NCI is valued as a proportionate share of net assets. So as I told you earlier, you in your exam question, you may be asked or you may be given the fair value of the NCI and you will be asked to calculate the goodwill. On the other hand, you may not be given the value of NCI and you are supposed to find out the value. That is by calculating the proportionate share of net asset which you have not acquired. So that is basically NCI. Okay. So here we will go through the question. So Pfeiffer Company acquired 80% of the equity shares of Grampian Company on 1st January 20x4 for 5 million. So you have paid 5 million to acquire 80% of the equity share of Grampian. So here you haven't acquired 100%, correct? So there will be an NCI which will be 20%. Okay. So again, the fair value of Grampian Company's net asset at the date of acquisition was 4 million. So they have already given us the fair value of the net assets which we have. The acquired company's net asset is given, that is 4 million. Okay. So let us again do it here itself. I think there is a space here. Okay. So first thing which we should take when we are calculating goodwill. So I'll write here goodwill. Okay, first is consideration transferred. So consideration is the amount which you have paid to acquired share in the company. So again, that is given. So on 1st January for 5 million. So you have paid 5 million to acquire 80% of the share in that company. So I've written consideration transferred as 5 million. So I am doing first of the requirement. So they have asked us to use the fair value of the net asset acquired. Okay. So as I've written, the fair value uh, of the NCI is 1 million. So what I will do is the next thing which we are supposed to take is the fair value of the NCI. So I'm writing here fair value of NCI, that is 1 million. Then we have to deduct the fair value of the net asset acquired. So fair value of net asset at the date of acquisition. So we are supposed to take the fair value of the net asset of the company which we have acquired. So again, that is given in the question. So if you look at the question, so the company which we have acquired is basically the Grampian company, and the fair value of the net asset at the date of acquisition was 4 million. So we deduct it in order to calculate goodwill. So again here you have basically paid 5 million to acquire 80% of the share. You haven't acquired 20%, but those shares are valued at 1 million. So that means uh, in order to acquire net asset worth of 4 million, it's almost 6 million which is required. So it's basically you are paying more than what you are getting. So the difference which you are paying is basically your goodwill. So here your goodwill is 2 million. Okay, so we have got 2 million as goodwill. The second requirement which you have here, so they have told us that NCI is valued as a proportionate share of net assets. So the value of NCI will change as a proportion share of net assets. So other thing will remain same. So again, I'll calculate the goodwill for two. So I'll just write GW. So again, consideration transferred. So I'll just write here consideration. So it will be same. That is 5 million. Fair value of NCI we won't use here. We'll just write NCI as NCI is proportionate share. Okay. So we have been given the fair value of the net assets acquired. So at the date of acquisition, the fair value of the net asset were of the subsidiary were 4 million. So we'll take that 4 million and we will multiply it with the proportion of NCI's share. So NCI has 20% holding. So we'll just multiply 4 million with 20%. So that will give us 800,000. So here NCI value has changed to 800,000. Less again the fair value of the net asset acquired. So I'll just write fair value of net assets. So that is basically again 4 million. So you have basically 5,800,000 minus 4 million, that will give you 1,800,000 as goodwill. So these are the two types of or two methods of calculating goodwill which you may expect in your exam. So this is your goodwill at the date of acquisition. Okay. So again, you need to for subsequent measurement each year you have to review goodwill for impairment. So when you are talking about intangible assets, so each and every intangible asset, unless it has an indefinite life, needs to be amortized. But when you are talking about goodwill, goodwill is not amortized. Instead, you have to review or test it for impairment. So again, we'll look at impairment later, maybe in the next chapter. So when you are talking about again goodwill and you have been given the fair value of NCI, so this is sometime called as full goodwill method. Full goodwill method. So when you are talking about full goodwill, so this will include the goodwill which is attributable to NCI as well. But when you are talking about uh, goodwill as a proportionate, when you calculate NCI as a proportionate share of uh, the net asset, here your goodwill amount is lesser, right? Because this won't include the goodwill attributable to NCI. So this is called partial goodwill method. Hope you guys have understood how to calculate goodwill. Again, there will be little complication regarding consideration. So you might be given contingent consideration or deferred consideration as well, rather than only having cash consideration. So we'll look at those example in the next session. Hope you have understood this section. If you guys have any doubt, then do reach to me. Thank you.